So take out your handout. Handout page 45. 46, 45 or 46. That's why you have the financial derivatives. Now, derivatives, they are more financial instruments which are used in international markets. For those taking advanced financial reporting, you see that financial instruments are classified into we have 4 types of financial instruments. One, we said it's financial asset, financial liability, equity instrument, and derivatives. So derivatives are in international markets. So what are those financial instruments? I mean financial derivatives. Now, derivatives are financial instruments whose value is derived from one or more basic variable known as the underlying or the assets. We're in handout page 45 or 46, depending on how you printed your handout. And what are some of the economic functions of derivatives? One is used to determine the prices. And then number 2, they are used also to transfer the risk. That means for hedging purposes. Number 3, they are used in checking speculation. You speculate so that you can make the short-term gains. And then number 4, they help in encouraging entrepreneurial activities. And then also to encourage savings and investments. And we have participants in this derivative market. And we have 3 types of participants. Number 1, we have the hedgers. Number 2, we have the speculators. And then number 3, we have arbitrators. Now, who are these participants? Now, hedgers, from the word hedging. Hedging is all about a strategy to minimize on risk. So therefore, hedgers, they are those participants who enter into derivative market with a major aim of minimizing risk. So the objective is for risk minimization. Therefore, for them, they are concerned with savings. They know that in saving, there is no risk. Then we have speculators. Speculators, now these are the real investors. They are those participants who enter into the market with an objective of making the profit. So the objective is profit maximization. Therefore, they don't fear risk. So they are risk takers. Then we have arbitrators. Now, arbitrators, they are speculators who are we can say risk neutral. They don't want to take much risk, but they want to make short-term gains. So therefore, arbitrators, they are also speculators who enter into market to make short-term gains. Short-term gains as a result of the fluctuation of the derivative prices. So we start with the hedgers. We think that these are participants who enter into the market to reduce the risk. Therefore, hedging is a mechanism to reduce the price risk. They are mostly concerned with savings. Then number 2, we have the speculators. Now, speculators, these are participants who enter into derivative market in order to make the profit. So if they are there to make the profit, therefore, they are willing to accept the risk. So that means they are risk takers. And then number 3, we have the arbitrators. And these are speculators who are interested in short-term gains, therefore making profit out of the fluctuations of the prices. Good. Now we look at the types of derivatives. And derivatives are classified into 4. Number 1, we have swaps. We have what we call the future contracts. Number 3, we have the forward contract. And then number 4, we have the options. Those are the 4 types of derivatives. Now, starting with the first one, swap. What do you mean by to swap? To exchange, correct. So therefore, now in international market or in derivative market, this is why we have participants who they want to transfer the risk by swapping. That means they want both to gain. So if they both want to gain, so they try to exchange the stream of cash flow, or whether the interest or whether the amount of cash flow, be it in loan. Then we have what we call the future contract. Now, future contract mostly is applicable for the international market, where there is a transaction where there is a foreign currency which is involved. That means, for example, if we export tea or hash avocado to China, are the farmers paid immediately? Sometimes they are not paid immediately. So it might take even 2 months or 3 months. So what happens once you take the you take the product, they might take even to 2 or 3 months. Let's assume they exported goods worth 1 million USD. But remember, the Kenyan farmer in here, the agency here, they need to pay the Kenyan farmer in Kenyan shillings. But you see, they used a standard currency, which is a USD. Now, assume that the rate of exchange at that date was 135. Do you expect after 3 months to be the same? No. So you expect the price of the dollar to fluctuate or to change. Let's assume at that time will be 139. Now, if you work with this, one change, I mean a change in that shilling or that rate, might bring what you call the exchange differences, whether an exchange gain or an exchange loss. So now the company, they adopt this strategy to try to hedge this future payment due to fluctuation. They carry the transaction now, they agree the amount in advance. Also, when the amount will be settled, they'll be settled at amount they had agreed earlier, regardless of the fluctuation of these prices. Yeah, that mostly is applicable for the future contract and the financial, I mean, on the forward contracts. Then we'll come to discuss later the option. Now let's start with the swaps. Swaps. Up there, we have the swaps. So what do you mean by swaps? This is an arrangement between two parties to exchange an asset or liability for a mutual benefit of each other. Can you underline mutual benefit of each other? Then mutual benefit. Yeah, where the two parties are benefiting. Is therefore an arrangement to exchange a stream of future payment concerning their own and interest. Therefore, it's a flexible private forward contract between two parties to exchange the cash flow, and it's classified into two as follows. So we have number one, the interest rate swap, and then number two, B, we have the currency swap. I have elaborated on everything here, so you can go through that. Now let's look at the future and the forward contract. The future and forward contract. Now, future contract is a legal agreement to buy or sell something at a predetermined price at a specified time in the future. While forward, they're almost the same. Forward contract is a customized contract between two parties to buy or sell an asset at a specified future time at an agreed price. Now, I want you to read the two definitions. Just read the two definitions and identify the difference between the two. You see, most the two are almost similar, but they are different. Now, what I was trying to explain here about the importation or the exportation, that was the future contract. You have already done the contract now. The transaction has already happened, but the amount will be payable in the future, which is predetermined. The amount is set in advance. You know the amount to pay in the future, the amount to receive. Then for the forward contract, this is why we enter into contract now, but the transaction will take place in the future. For example, assume that I promise you that at the end of this financial year, I'll sell you a piece of land. Not now, later. Let's assume I have already leased to someone else. Then at the end, after the lease contract has ended, I'll sell to you that land. And then we even agree the price. I'll sell that piece of land at 10 million. We agree in advance and we write a contract. Now that's what we call a forward contract. We have agreed in advance, but the transaction is not taking place now. The transaction will take place in the future at a predetermined price. If you had agreed it's 10 million, and then there is another investor and he paid 11 million, so in that case, remember we had already agreed the contract in advance. So therefore, that's why you're saying that for the future contract, it's a legal arrangement. So this one is very binding. But for the forward, it's done over the counter. It's all about based on a mutual agreement. We don't need a witness, don't need a guarantor. But for the future contract, you need a guarantor. You exported coffee worth $1 million US, and they'll pay after 3 months. What if you default on payment? So that's why, because the transaction has already happened, we need a guarantor. But for the forward contract, it's all about the mutual agreement between the two. You have not paid anything. We have just agreed in advance. So I think I've given you some of the differences. That this one is binding. This one is an over-the-counter based on the mutual agreement. This one requires a third-party guarantor. This one does not require a guarantor. So that means the future contract, the risk of default is very low. Why? Because in case they default, there is a guarantor who will pay that amount. So now let's look at the differences between the two, the difference between the future and the forward contract. Now, for the futures, they are traded in an organized or formal market. Forward, they are traded on an over-the-counter market. That's what you call the informal market. And then for the futures, future involves a standardized contract, but for the forward, involve negotiated contract term. We can be able to negotiate. Then for the future, there is a need for third-party guarantor. For the forward, there is no need. There is no third-party guarantor. Then futures, they are always quoted on American terms. What do you mean by American terms? Always in USD. Just write USD. They are quoted in American currency. That's the USD. But for the forward, they are quoted in any other currency. Then for the futures, the size of the contract is fixed. But for the forward, the size of the contract keeps on changing. Good. So now we have discussed about the swaps, the future, and the forward. Now the main focus, or my main focus now, will be on options. Options. What's an option? Go back where you have the options. Now, an option is a contract which gives the buyer or the seller the right but not obligation to buy or sell a specified asset or security at a specified price on or before a specified future date. And that's almost equal to the definition of a financial instrument. Is a contract which gives one party, either the buyer or the seller, the right but not obligation to either buy or sell a specific asset or security at a specified price at a specified period in the future. So in this case, we agree in advance. So in that case, that specified price in the future is what we call the strike price. Strike or the exercise price. So we're saying that an option is a contract that gives the buyer or the seller the right but not obligation to buy or sell the specified asset or security at a specified price on or before the specified future date. The specified price is known as the exercise price. In this case, the parties are required to pay an unrefundable fee known as the premium. So therefore, in international market, when you talk about the premium, premium means the transaction cost. Because we're saying that in this case, the parties to the contract, they'll have to incur that non-refundable fee, which is known as the premium. So that means the premium is the cost incurred to enter into those contracts. So we look at the type of options. And we have two types of options. Number one, we have what we call the core option And number 2, we have put option. Now, what's the difference? Now, call option, when we are calling, that means you are calling the customer. It gives the buyer the right. So this one gives the buyer the right but not obligation to buy securities at a specified price at a specified period of time. Put option, you are the one putting. That means you are selling it. So you are the seller. So put option, on the other hand, these are options which gives the seller the right. It gives the seller the right to sell. Call option gives the buyer the right to buy. And this one is the right to sell. And how do you determine the value of the call option? Now, this is how you determine the value of the call option. To determine the value of the call option, you take maximum market price per share, you compare against the exercise price or the strike price with non-negativity assumption. But for put option, you are the one selling. So that means you are exercising. So you compare the exercise price or the amount you are selling against the market price per share. So to get the value of the put, on the other hand, you take maximum exercise price minus the market price per share with non-negativity assumption. That means you cannot exercise if you are getting a negative value. So in this case, it's MPS minus exercise price. Yeah, because you as a buyer, you are comparing how much is the market price against how much am I paying to determine whether it's a profit or loss. And I will determine the profit or loss on transaction. For the call, you'll take the value of the call, you minus the cost you had already incurred to effect that transaction. And that's what we call the premium. For put option, if you want to determine whether you're exercising at a profit or loss, you will take the value of the put, then you raise also the transaction cost known as the premium. So you're looking at type of option. Number 1, we have the call option. This is a financial contract which gives the buyer the right but not obligation to acquire a given number of securities in the future at a predetermined price. The value of the option, of the call option, is expressed as follows. So I think I have explained everything. Now, the call option can only be exercised if the price of the option at the expiry date is greater than the exercise price. You should only exercise if the market price is greater than the exercise price. If the market price is greater than the exercise price, automatically you get a positive value for the call. Then number B, we have the put option. Now, this is a financial contract that gives the seller the right. It gives the seller the right, but not obligation to sell a given number of security at a future in the future at a predetermined price. The value of the put option is expressed as follows. I explained everything here. Now, the put option can only be exercised if the price of the option at the expiry date is lower than the exercise price. I should only exercise if the market price is lower than the exercise price. What does that mean? For you to exercise, the exercise price for you to gain must be greater than the market price per share. That's when you get a positive value. Now we look at option style. Now option style can be classified into two. A, based on settlement date, and B, based on the profit or the payoff. Based on payoff. Now, based on the settlement date, option style are classified into three. Number 1, you have what you call European option. Number 2, we have American option. And number 3, we have Bermudian option. And what's the difference? Now, a European option is an option whereby it can only be exercised upon maturity. Only upon maturity. That means you cannot exercise before. The date you had agreed in advance, that's when you can only exercise. That's what we call European option. It's an option whereby it can only be exercised upon maturity. For American option, is an option whereby The option can be exercised on or before the maturity. Can be exercised on or before maturity. So that means it's very flexible. Then Bermudian is more like American. It's an option whereby you can exercise on or before the maturity period, but in this case, you have to specify the date in advance. There you can exercise on or before maturity, but you need to specify the date. So you need to be specific. Those are the three types of option based on the settlement date. What about on the payoff? Now, payoff is all about the profit. Also, based on the profit, they are classified into three. We have what we call in the money option. Then we have out of the money option. And then we have at the money option. Now, based on the payoff, they are classified into three. We have in the money option. Now, in the money option, this is an option whereby if it is exercised today, a profit will be realized. That's what we call in the money. So profit is realized. Out of the money is the opposite. What do you think out of the money will mean? Yeah, this is an option whereby if it's exercised today, a loss will be suffered. So in this case, there will be a loss. Then we have at the money. Now, at the money is an option whereby if it's exercised today, it will break even. Break even, that means that there is no profit, no loss. That means the revenue will be equal to cost, and therefore the profit will be zero. Good. I can evaluate that on your notes. Option style. There are three basic types of option based on their settlement date. One is the European option, and this gives the holder of the option to sell or buy an asset on the expiry date only, and therefore it can't be exercised earlier. And then number two, we have the American option. Now for American option, this option gives the holder the right but not obligation to buy or sell on or before the expiry date, on or before. So that means it's very flexible. And then number three, we have Bermudian option. Under this option, the option can be exercised any time before maturity date, but the date of exercising is normally specified when the contract is signed. Then we have the option categories based on the payoff. Number one, we have the in the money option, and this is where if the option is exercised today, a profit will be realized. B, we have out of the money option, and this is when if the option is exercised today, a loss will be suffered. And then C, at the money option, this is where the option is exercised now, there will be no gain or loss. That means you'll just break even. Okay. Now let's do that illustration. Illustration one. Suppose a security has an exercise or strike price of 30 shillings with a premium of 5 shillings. Determine the value for both call option and put option, as well as the profit or loss, assuming the following prevailing market prices. Read the question again. So now we get the value of both core and put. Now let's start with the core option. So you have to evaluate, and you're given the prevailing market price per share. When the market price is 20, 25, 30, 35, 40, and 45. So how do we get the value of the call? So to get the value of the call, it's maximum market price per share minus the exercise price with non-negativity assumption. So take the market price per share when it's 20, 25, 30, 35, 40, and 45. Then you minus the exercise price. How much is the exercise price? Yeah, exercise price we have is 30. $45 minus that you get? 40 minus that you get? That 5 minus that you get? 30 minus that you get? 25 minus that you get? 0. 20 minus that you get? 0. That's what we mean by non-negativity assumption. Non-negativity, that means there is no negative. You cannot exercise when there is negative. So that's why we wrote this 0. So if you take 20 minus that, you'll get negative 10. So you indicate it as 0. So there is non-negativity assumption. Then let's determine the profit or loss. How do we get profit or loss? To get the profit or loss, we say that you take the value of the call, you minus the transaction cost, known as what? Premium. Good. So you already have the value of the call. This is what you have computed. This was 0, 0, 0, 5, 10, and 15. Then you minus the premium. How much is the premium? 5. $15 minus 5 you get? 10 minus 5 you get? 5 minus 5 you get? 0 minus 5 you get? Negative 5. 0 minus 5 you get? Yeah, here you are determining the profit or loss. So can either be a profit or loss. Now, when you get a negative, how do you call that option? Now, this is what you call now out of the money option. If you get 0, what do you call that? At the money option. And when you get a positive, that's what you call in the money goods. Now you evaluate the same now for the put. So to get the value of the put, you take max. Put gives the seller the right. So if you are selling, how much price are you selling at? Now that's what you call the exercise price. You compare against the market price per share with a negativity assumption. So the exercise price was 30. Then we evaluate at different market prices. This is 20, 25, 30, 35, 40, and 45. 30 minus 20 you get 10. This one you get 30 minus that you get 30 minus 35 you get 0. Good. Now let's determine the profit or loss. For the put, you just take the value of the put, you less the transaction cost known as the premium. So take the value of the put option, that's what we have computed here. We have 10, 5, 0, 0, 0, 0. Then you minus the premium. Premium was it 5? Yeah, the transaction cost was 5. 10 minus 5 you have? 5 minus 5? This one you have is negative 5, negative 5, negative 5, negative 5. So this is what you call in the money. This is at the money. And this is out of the money. What does it mean? Now, if you are the seller, you only sell when the market price is 20. Because if you sell when the market price is 20, but you see you are not selling at 20. 20 is the market price. You are selling it at that. But assuming the market price is 45, but you are exercising at 30. definitely you are selling below actually the market price. So definitely you make a loss. Good. Question? So that one is already in your notes, exactly the way it is. So I want us to recap the two. How do we link the value of the call and the value of the put? So when linking the value of the call and the value of the put, they are linked using a theorem known as the put call parity theorem. And this is a theory that tries to link the value of the put and the value of the call. According to put call parity theorem, to get the value of the put, you take the value of the call minus the market price per share denoted by PA plus the exercise price denoted by E, then exponential raised to power negative RT, where what's P, what's C, what's P, what's E, what's A, what's R, what is T. Now this is the value of put option. This is the value of the call option. P is the market price per share, is the exercise price, also known as the strike price. E, this is exponential constant, constant, which is 2.7183. Now take out your calculator. How do you get the exponential constant? Press shift, natural log. Natural log. The button is writing like this. This is what we call natural log. Let me show you where it is. Now, for those who can't see the natural log, but we have the on button. Below it, we have x cubed. Then below it, there is in. That in is what we call the natural log. So press shift natural log. What do you get? E. Then press 1 equals. Press 1 equals. 1 equals. What do you get? 2.718. Yeah, that's what we call the exponential constant. Then R, this is the risk-free rate. Then T is a time to maturity. Time to maturity in years. Yeah, you need to understand that. That T is not just time. It's time to maturity in years. If you're told that the contract will be effected in the next 3 months, that means your T will be 3/12. You convert it into months and you get 0.25. Good. So now let's evaluate that in our notes. Put call parity theorem. Now, this is a theory which links the price of the call and put option, and therefore it determines the price of the call and put option in a manner that arbitrage opportunities are eliminated. The theory is expressed as follows. I think I've explained everything about the put call parity theory. Good. Now let's look at option pricing model. The option pricing model. How do we price those options? We have 2 methods you can use. We have 2 models you can use to determine the value of an option. One is known as the binomial model. And number 2, we have Bracken scores. model. Yeah, those are the two methods. Starting with the first one, that's the binomial model. Now, under this model, it assumes that two prices will exist upon maturity. What does that mean? That means the value can either go up or can decrease. That means the value of the option can increase or decrease. So that means it assumes, the major assumption, that there are two prices which will exist upon maturity. And how do we evaluate the value of the option using the binomial model? So we have some steps followed. Number one, you need to determine option delta. How do you determine the option delta? So to get the option delta, you take the change in option value, you divide by a change in option prices. So that's the first step. You determine the option delta. When you have the option delta, step number two, you need to determine the value of the portfolio. Now determine the value of the portfolio. So to get the value of the portfolio, you take the market price per share, you discount by multiplying by the option delta. And then you deduct the value of the option. Then the third step, you need to determine the present value of the portfolio. How do we get the present value of the portfolio? So to get the value at the present value of the portfolio, you take the value of the portfolio. Yeah, the one you computed in step number two. Then you multiply by exponential constant raised to power RT. And lastly, number four, you determine the present value of option portfolio. And how do you determine the present value of the option portfolio? So you'll take the actual market price per share, you multiply by step number one, that's the option delta. Then you deduct step number three, that's the present value of portfolio. Those are the steps followed in binomial model. I'm sure you don't have a question. Now let's do a question so that you can understand what I'm saying there. May 2014, question 4D. May 2014, question 4D. May 2014, question 4D. Let's start with part A, 4A. 4A, differentiate between the future contracts and forward contracts. Give me the difference between the two. Future, quoted in American terms. Yeah, the other one is quoted in any other currency. Sorry? Future, there is a guarantor, third party guarantor. What about for the forward? There is no guarantor. Another one? For future. Sorry? In the future. The agreement has already been done, but the transaction will take place in the future. You have decided to differentiate using the definition, which is very correct. For the forward, over the counter market or the informal market. For the future, formal market. Yeah, good. Part D of the question. A stock currently sells for 36. Now that's the actual market price. And then you're told that in the next 6 months, that's T, the price will either increase to 42 or decrease to 31. You see, in binomial, you see that the major assumption is that the prices the two prices will exist upon maturity. Can either increase, can either go down. So automatically that's binomial. So you're told that in the next 6 months, the stock price will either increase to 42 shillings or decrease to that 1 shilling. And the risk-free rate is 4% per year. Required. Calculate the current market price of a call option on the above stock if the term to expiration is 6 months and the strike price is 35. Read the question again. The first step, you need to determine the option delta. And how do you get the option delta? So to get the option delta, take the change in option value, you divide by a change in option prices. Let's get that. And you go back to the required. What is the question? The current market price of the call option. So we need to get the option value. So how do we get the value of the call option? To get the value of the call option, it's max market price per share, exercise price with zero non-negativity. Now, upon maturity, two prices will exist. Either, it's okay, give me those prices. Either 42 or 31. That's the market price per share. Then you minus the exercise price or the strike price, which is 35. Now that's how you get the option value or the value of the call. This is 7. That one minus that 5 you get 0. So you take the change in option value. We have a value of 7 and 0. So it's 7 minus 0. Then you divide by the change in option price. Can either be 42 or that one. The difference is 11. So it's 42 minus that one. 7 over 11. You mean to 4 decimal places. Six, 4. So that's the first step. You determine the option delta. Step number 2. You determine the value of the portfolio. And how do we get the value of the portfolio? So to get the value of the portfolio, so that you take the market price per share, you multiply by the option delta, then you minus the value of the option. Now the question is, the market price per share, two prices will exist upon maturity. Can either be 42 or that one. Now, where can you exercise or when can you exercise? When the price is 42. In short, is the one giving you a positive value. Are you together? So you take the one giving you the positive value, which is 42. You multiply by the option delta, which is 0.6364. Then you minus the value of the option. If you exercise that 42, it will give you a value of how much? Yeah, the value was 7. Good. Sorry? 7.3, eh? Good. So that's the second step. So determine the value of the portfolio. Then number 3, you determine the present value of the portfolio. Now do you get the present value of the portfolio? So you take the value of portfolio, multiply by E power RT. The value of the portfolio we have is 19.73 times exponential constant raised power negative R. R was the risk credit. How much was the risk credit? Sorry? So 0.4. T is the time to maturity. Give me T. The 6/12 is 0.5. I will say that T is the time to maturity in years. So first of all, start with this. Now listen up here. Listen up here. How do we get E? Press Shift Natural Rock. Shift Natural Rock. Then the next step you do what? Don't write raised to power. Let me repeat again. We say that exponential is the same as 2.7183. Now, if you decide, if you understand that number well, if you use 2.7183, that's when you write raised to power 0.4. Now, can you look at that button where you have natural rocks? Angalia kwa hiyo button. Hapa juu imeandikwa aje? E raised to power x. So if you use exponential the way it is directly, it's already raised to power. So if you write to another raised to power, it will give you a wrong answer or syntax error. So, but if you decide to substitute this, you use 2.7183, that's when you write raised to power. If you use E the way it is directly, it's already raised to power. So that's what you'll do here. Press on, press on. Let's clear everything, press on. So you'll take Shift Natural Rock, you get E. Don't read raised to power. So open the bracket, negative 0.04 times 0.5, close the bracket, equals. Then you can multiply by 19.73. You get 19.34. Good. So that's the present value of the portfolio. Lastly, you determine the value of option portfolio. And how do we get the value of the option portfolio? You take the actual MPS, you multiply by the option delta, then you minus the present value of portfolio. Give me the actual market price per share. Yes? That is 6. You multiply by the option delta. How much is the option delta? 0.6364. And then you minus the present value of the portfolio. How much is the present value of the portfolio? Yeah, that was our step number 3, 19.34. So what do you get? Three point? So I want you to understand that. May 2015, question 3C. You do it now. Do it now. I'm coming to mark. For the honest student, once you do that, you submit your answer. The last one. I don't want the working. What are you getting? Yes? 6.62, eh? 6.2, eh? Now let's do it very quickly. Eh? That one should not take you even more than 3 minutes. Now, this you are told that a share is currently selling at 120. There are two possible prices of the share after 1 year, 132 or 105. Assume that the risk-free rate is 9% per annum required. The value of 1 year European core option with an exercise cost of 125. So step number 1, we get the option delta, of which you take the change in option value, you divide by the change in option price. Value of the call, it's max, market price per share minus the exercise price 0. The price can either be 132 or 105. And the exercise price we have is 125, 125, 567, this is 0. So you take the change in option value, 7 minus 0, you get 7. 132 minus 105, you get 132 minus 105, not 0. Sorry? 27. So the change in option value is 7 minus 0, which is 7. Change in option price, 132 and 105, which is 27. And you got 0.25? 93. Then the next step, you ask yourself, of the two prices, which one is giving you a positive value? 132. So you take 132 times the option delta of 0.2593. Then you deduct its value. It's giving you a value of how much? 7. What do you get? 27.22. Then the next step, once you get the value of the portfolio, you get the present value. So to get the present value, take 27.22 times ERT. So it's 27.22 exponential constant 2.7183. How much was the risk-free rate? Sorry? 0.09. Time to maturity? 1 year. And you got 20.88. Eh? Then lastly, you take the actual market price. How much was the actual market price? 120. You multiply by the option delta 0.2593. Then you deduct step number 3, 24.88. You got how much? That's it first. Yeah. Ukiambiwa 2 years, CT inakuwa 2. So that's all about binomial. It's one method of option pricing. Now we look at the second method, which is bracket scores. Yes? Yes, the same. Also a price for put. So the other method is bracket scores. Now, according to bracket scores, there were 2 groups also in finance. And they say that the value of the option will take a continuous trend rather than just 2 prices. You see, in the binomial, it's assuming that 2 prices will exist. Now, according to bracket score, the price will take a continuous trend. A continuous trend. And according to bracket score, how do we get the value of the call? So to get the value of the call according to bracket score, and the reason here, China notes. Value of the call will take PND1 minus the exercise price ERT ND2, where to get D1, you take the natural log market price per share, exercise price, plus the risk-free rate, a half standard deviation square, you multiply by t, you divide by the standard deviation square root of t, and then to get d1, d2, it will be d1 minus standard deviation square root of t, where what is p, what is e, what is n, what is in, what is that? P is the market price per share. This is the exercise price. And one of the major assumptions is that it assumes the price will follow a normal distribution. So this is a normal distribution. In, this is what we call the natural log. This is the standard deviation, also known as volatility. You already know it is time to maturity in years. R is the risk-free rate, E exponential constant. Good. Now let's go back to our handout. Now you look at the second model. That's Brackens score. Brackens score. Now this model is used to derive the fair value of the call option. It is used where the share price at the end of the expiry period can take a continuous value rather than just two values. The model is based on the following assumption. Remember, most of the assumptions are the limitation. One is that the rate of return on the share follows normal distribution. That's very correct. The risk-free rate is constant. That's also a limitation because if you assume the risk-free rate is constant, sometimes it keeps on changing. So therefore, that's not the truth. Then also assume that the market is efficient and there is no transaction cost and taxes. So it's also a limitation because that's not correct. Also, the option is an European option. It's also a limitation. That means they can only be used to evaluate an European option. Therefore, cannot be used to evaluate an American option or Bermudian. Then it assumes there is no restriction or penalty. The share price is continuous and random. Also assumes there is no dividend payment. Assumes that the company does not pay any dividend. Now, according to Brackens scores, the value of the call option is calculated as follows. So there's the formula. Now, what are some of the factors affecting the value of the call? Now, for you to understand the factors affecting the value of the call, you just need to understand what I have done here. Now, those ingredients required to get the value of the call are what affects the value of the call. That is the market price per share, the exercise price, the risk-free rate, standard deviation, time to maturity. Those are the factors that affect the value of the call option. So number one is the market price of the security. And I've explained how does it affect. Number two is the exercise price. We have the risk-free rate, time remaining to expiry. You also have standard deviation or volatility. Now, what are some of the limitations of Brackens scores? And most of the assumptions are the limitation. Number one, the model is only applicable in European option. It assumes that the risk-free rate is known in advance and is constant throughout, which is not correct. It assumes that there is no transaction cost or tax effect involved, which is not correct. It assumes that there is no dividend paid during the period, which is not always correct. Then we have Greeks. What do we mean by Greeks? Greeks. Kama saizi mnasikia mwalimu anaongea Kigiriki, eh? What does it mean? Yeah? When someone tells you wacha kuongea Kigiriki, what does it mean? Anaongea kitu amuelewi, si kweli? So kwa hivyo Greeks are what? Yeah. Things you don't understand. Yeah, Greeks. These are sophisticated tools used to measure the variation of an option premium, and they include, one is the delta. You already know what's an option delta. They even showed you how to get the option delta. You take the change in option value over change in option prices. Number two, there is gamma. Number C, there is theta. Number D, there is vega. Number E. Brayo ni jina gani? Rho. Gitonga. What's that name? Caro, what's the name? Rho. Rho. Is it rho or ho? Which one is silent? Yeah, for those who went to group of schools. Which one is silent? R. H. Yeah, so now let's evaluate some question on that. June 2010, question 5. 5B, June 2010, question 5B. We start with part A of the question. No, B, part 1. Explain the key factor that affects the value of the option. Which are those factors that affect the value of the option? Exercise price, time to maturity, standard deviation, risk-free rate, time to maturity. Let's go to part C of the question. Part C of the question. Outline for limitation of Brack and score option pricing model. Sorry, can only be? Can only use in European option only. It assumes the risk-free rate is constant. It assumes there's no dividend. These are assumptions. Now these are limitations. What you're saying are the assumptions, right? Yes, of which I said that most of the assumptions are limitations. But in this case, we don't want assumption, we want limitation. Point number 1 was correct. Can only be used to evaluate European option. Can you reframe the rest? It assumes there is no payment of dividend. Yeah, which is not the case. That's correct. There is. Can you reframe that? Now answer that again. The risk-free rate is known in advance. Now, and it's constant. That's an assumption. So I want limitation. Which is not correct? Yes, you say that it assumes that the risk-free rate is constant, which is not always the case, right? Yeah, those are 3. Sorry? It assumes there is no transaction, which is not correct. B part 2. Mapema Limited shares are currently trading at 3.5 Now that's P. The market price per share is 3.5. A European call option, it's a call option, exists on the shares with an exercise price of 3.3. Exercise price is 3.3 with a 3-month to maturity. T, it's 3/12. You get a quarter, which is 0.25. Risk-free rate is 8%, R it's 0.08. And the variance on the rate of return on the share is 12. Now, variance is standard deviation square is 12% required. Determine the value of the call option using the Brack and score. Determine the value using Brack and score. So for Brack and score, step number 1, you need to get D1 and D2. And how do we get D1? It's natural of P/E plus risk-free rate, a half standard deviation square multiplied by T over standard deviation square root of T. Then to get D2 is D1 minus standard deviation square root of T. You take natural of P, you have it's 3.5, exercise is 3.3, then you add, the risk-free rate is 8, so it's 0.08, then you add half, standard deviation square, we already have the variance, it's 0.12, that one don't square because this one is standard deviation is square. In this case, we already given the variance, so they have already squared. Then you multiply by T, T is 0.25, all of which you divide by standard deviation. So the variance is 0.12. To get the standard deviation, you do what? You get the square root times square root of T. T is 0.25. Yeah, using a calculator is a concept. So can you employ BODMAS? Can you do what I say before you get a wrong answer? Sana sana wenye hanipeagi answer kwa class, they cannot be able to get this. Now let's start with bracket, BODMAS. 0.5 times 0.12 equals. Na sio kusikiza, unaangalia kenye nafanya hapa. Then you add 0.08 equals. You multiply by 0.25 equals. You add natural log, finya IN. Don't press shift. Finya natural log, IN. Open the bracket. 3.5 divided by 3.3. Close the bracket. Equals. Answer divided by, open the bracket, square root of 0.12 times square root of 0.25, close the bracket, press equals. If you're confident enough, give me the answer. 0.5. Correct. That means you are reasoning. Yeah, actually D1, D2 should always be into 2 decimal places. I'll come to explain why. For those who are not reasoning, they did get 0.5 form. To get D2, you need D1. So that means if your D1 is wrong, also D2 is wrong. So take D1, which is 0.54, you minus this, the denominator here. Standard deviation, which is 0.1, you get the square root times square root of T, 0.25. So answer you minus, can you minus that? I have said that it should be into 2 decimal places. 3, 7. Why is it into 2 decimal places? Now let me explain something here. I say that when getting the value of the call, we need ND1, not just D1. D2, we need ND2, where N is the normal distribution. So how do we get ND1, ND2? N means the normal distribution. Let me take you back to quantitative analysis. That's what we call a normal distribution. And a normal distribution, the area always, the probability is always equal to 1. It assumes equal probability. So this one will be 0.5. This one will be 0.5. So what we have here is this proportion. So if D1, D2, they were positive, you'll take 0.5. Now you are taking this half, then you add this probability. You add. If ND1 and D1 and D2 were negatives, assume this was negative 0.54, could have taken 0.5 minus. So how do we get now this? Now take out your notes, the notes I had shared with you, the last page, or still you can use your past paper. From your past paper, 2 pages after that, there is a normal distribution. You'll see a curve like this. Just look for a curve like this. Just look here. The last page. It's also in your question paper, wherever you see a like that. Are you there? Good. So now let's start with this one, 0.54. Now in that table, it's known as Z distribution table. You look where you have 0.5. Then where you have, here you have 1, 2, 3, here we need 4. Give me that probability. 0.5, then you go where we have 4. That's why it should be into 2 decimal places. 0.51. 0.37. 1,446. Now what you got, now this was this area under shaded part. If it's positive, you add the other 0.5. So 1,443, eh? Good. So that means to get ND1, you'll take 0.5. Now D1 was 0.2051. For D2, the present value is 0.1443. That will be 0.7051. 0.6443. Now we can get the value of the call. Value of the call, say that is ND1, sorry, PND1, PND1 minus the exercise price ERT ND2. Or to get the value of the put, you can take P ND1 minus E exponential RT ND2. This one and this one is the same. So if you divide E, don't write raised to power negative. Are you together? Be just positive. But if you decide to multiply, you write this negative. So we have P. How much was P? 3.5. Then you multiply by ND1. ND1 is 0.7051 minus the exercise price, which was 3.3. You divide by E, 2.7183 raised to power RT. R was 0.08 and T was 0.25. All of it, you multiply by ND2. So our ND2, we have it 0.6443. Employ body mass. What are you getting? Just be confident with your answer. If you know how to use a calculator, give me the answer. You're getting? Yes? If you're getting negative, it's wrong. 0.38, 38? Yes. I can see most of you are computing. That means you don't get that answer. Now, you want me to teach you the formulas, everything, even how to use a calculator? That one I'm not showing you. Sorry? D1 inafaa kuwa hivyo na D2 venye tu iko 0.5 imetoka wapi? Iko kwa formula. Si hapa kwa formula tulisema it's 0.5 Mwingine aulize mbona tumedivide. Post a formula which were well researched. Are you together? Before I come up na formula. So hiyo siwezi elezea ni nini. So that was the Bracken's course, of which there were threats with Modiglian and Mira. They got problem. Now let's do another illustration. May 2014, question 5C. May 2014, question 5C. December 2014, question 5C. Now let's start with part B. The introduction of integrated financial management information system, that's IFMIS, has been promoted as a core component of public financial reform in many developing countries, including Kenya. Analyze 4 benefits that could accrue from the implementation of IFMIS. 8 marks. I know you are saying that John Mark has not taught you. Yeah, actually that's under the topic of emerging issues and contemporary issues. That one is not a topic. That's what they ask. Anything which is happening around the globe that pertains to financial. Where do we use IFMIS? Have you heard of IFMIS? Where? The government. Yeah. You know, there was a time, there was one of the minister, the CS. That's 4 years ago. Alikuwa anaulizwa, what is happening to the money? You're not giving the money to the county government. The IFMIS failed. The IFMIS failed. What's IFMIS? It's the integrated financial management information system. How does it work? Or what's the importance? Now that's why you're asking. What's the objective? You cannot know the objective, you don't know how it operates, right? How does it help IFMIS? Most of you are working in the audit department. if miss. And actually it had made the work of an auditor general to be very easy. It's used to correct. It's like, sasa, now put that one in words. Yeah, nowadays even most of the government organization, for example, when we are dealing with auditor general, we have most of the students who are being sponsored who work with the auditor general. Yeah, so they require also the if means we need to register even for us if means. So that means even if you audit their books after 4 years, they'll be able to tell you or to account for every money. The money from the account directly went to KCE. The money from the exchequer or from treasury went to this ministry. From this ministry, they paid this contractor. From this contractor, also paid another service subcontractor, like that. That's what it's called integrated financial management information. It's all about trying to bring about accountability. You can be able to account for the money. And actually, this thing was introduced way back in 2014. Now in Kenya, when was it implemented? No, not 2014, but 2012. But when was it implemented? Have been effective for how many years? Not been that much. You know, when you introduce a new system to the government, now for those who work with the government, one of the key policy, there must be a resistance. Why? You know, that's a fear of change. For you have been working with the government for 10 years or 5 years. Well, even if you close your eyes, you know how the system works. Hii unatoa hapa unapeleka pale. Now you try to alter that. So umeambia huyu mtu afanye extra work. So that's why they always resist. Yeah, and also, if means the major objective was to try to bridge those loopholes. Yeah, for example, if you take a case of the revenue correction here in Nairobi, how do you to pay the parking fee? Some years before, some years ago, you used to get a lady on a white coat, or a guy, namlipa 200 ama 150, anakupea nini? Is it? What about now? Nowadays, everything have to go to where? To the KRA department of Nairobi. Actually, you pay to the Kenya Revenue Authority directly. They are the one managing the revenue collection in Nairobi. So at least for that case, they can be able to account. What about Kitambo? Not accounted for. So therefore, nimemeuliza swali, I'm waiting for your answer. I'm trying to explain so that you can understand what we mean by if means. So what are some of the, now the question is, unless for benefit that could accrue from the implementation. So that one was time they have not yet implemented. So that's why they were asking for benefit that could accrue from implementation of if means. Now, what's the benefit of now adopting if means? We have already adopted if means. Number one, there is? Yes, number one, there is accountability. Also, it enhances easier audit of the public institution. Another one? Yes, apart from accountability, it helps to minimize on the fraud that used to happen. Because, you know, in this case, all the money will be followed. The way it moved from the directive from the exchequer to this ministry account to the contractor, how much was it paid? How much was paid at this specific date? All that. Yeah. So in short, everything has been integrated. Now, part C of the question. A European core option trading in the security exchange has an exercise price of 40. Exercise price of 40. Its maturity date is 6 months from now. T is 0.5. The current stock price is 28. P is 28. And the instantaneous variance of the return on the underlying asset is 0.5. Variance is standard deviation squared. It's 0.5 also. The risk-free rate is 6%. R is 0.06. Required. Using the bracket score option pricing model to compute the value of the core option. You need to get D1, which is natural log P over A plus risk-free rate, a half, standard deviation square T, standard deviation square root of T. We get that. And natural log P we have is 28. E we have is 40. Then you add the risk-free rate 0.06. You add a half. Standard deviation square, you get the variance, of which you already have the variance, 0.5. You multiply by t. T is 0.5. Then you divide by the standard deviation, which is 0.5. Now this was the variance. So to get the standard deviation, you get what? The square root times square root of t. How much was t? 0.5. I repeat again, apply body mass and give me your answer into 2 decimal places. Some of the other points from the honest student, it enhances uniformity, which is very correct. Also has helped to reduce the paperwork. So I can see now you understand what we mean by ifness. Mnakizanga nikifunza wanafunzi kwa hivyo nisiwadanganye. You are done, eh? What are you getting? Negative 0.40. How sure are you? Unajua your confidence pair nayo. First of all, you have computed, then you confirmed whether it's the one in the notes. But it's negative. Now let's get D2. D2 is D1 minus standard deviation square root of t. So it's negative 0.40. Standard deviation is 0.5, which was the variance. You get the square root times square root of t, 0.5. What do you get? Negative 0.90. Good. Now I want to get the probability. Now let's go to the normal distribution curve. Ignore the sign. Ignore the sign. Ignore the sign. The first one is 0.40. 0.40. 0.40. We get 0.1554. 0.90. 0.90. 0.59, eh? Good. So ND1, ND2, it's 0.5 plus or minus? Minus. Good. We see that if D1 and D2, they are negative, you minus. So here you minus 0.1554 minus 0.3159, get 0.3446, right? 0.1841, right? Easy mathematics. Value of the call P ND1 minus the exercise ERT ND2. P is 28, ND1 it's 0.3446. Then you minus the exercise price. The exercise price is 40 over exponential, which is 2.7183 raised power R. And the risk free rate was 0.06, T 0.5, all of it to multiply by ND2, which is 0.1841. Body mass. You are getting 2.50, eh? Now, what if now we are to get the value of the put? What if we are to get the value of the put? Now, in this case, it was very specific. We get the value of a European call option. If you are to get the value of the put, we use what we call the put call parity theorem. Say that to get the value of the put, you take P minus, sorry, not P. So that under put call parity theorem, to get the value of the put, you take the value of the call minus the market price per share plus the exercise price ERT. Would have taken the value of the call, so that means you have to follow the same process that the brackets go, which is 2.5 minus PA. PA, we see that is the market price per share, which is 28, minus E is 40. Small e, the exponential constant is 2.7183 raised power negative R. R was 6%, 0.06 times T, time to maturity is 0.5. So now give me that. What are you getting? Sorry, this was plus, eh? But I will give me a wrong answer. 97, eh? Yeah. 97, What about the rest? Sorry? Sorry, 30? 35, Be negative, eh? Those are two answers. What about the rest? Nana, what are you getting? Negative 41, 13.3, eh? Yeah, those are four answers. Eh? Yeah. So, that's you're getting how much? Yeah, you applied body mass. Eh? Now, these are your applied body mass. Let me show how to use a calculator. Eh? So, can you take 2.7183? Nana, I hope you are there. Eh? Raised to power, open the bracket. negative 0.06 times 0.5. You close the bracket, then you press equals. Now you have dealt with that. Then you multiply by 40. Multiply by 40 equals. Are we there? Now, what Nana did, she added 28 and then took 2.5 minus answer. In BODMAS, that's how no, it's not how it works. This is negative 28. So what you'll do, the answer you got, can you add 2.5? And then you minus 28. The value of the put will be how much? Now I want us to look at the last part, what we call the lead option. So the lead option, what we have been evaluating here, we are evaluating securities. What if you are given a project? Maybe you want to expand a supermarket. You want to expand a business. Now that's what we call a lead option. So in case of a lead option, how do you apply brackets for? The concept is the same, nothing changes. The only thing that changes now is P and E. Because remember, you say that P is the market price per share. But in this case, we're evaluating a project. E is the exercise price per share. Now, in this case, we're evaluating a real project. So in case of a real project, P is the present value of cash inflow. E, the exercise price will be the present value of cash outflow, but the option involves abandonment. You take the abandonment value or the salvage value. That's the only difference. Then from there, the evaluation is the same. So let's go back to our notes or handout. After where we had the Greeks, we have the lead option. For those using the handout, for those using the notes, also there is a lead option in the notes. Now, lead option, these are investment projects that gives the management the right but not obligation to either delay, withdraw a project, or expand a project. They are long-term projects in nature. That's what we call the lead option. So types of lead option, we have option to delay the project, option to expand the project, option to withdraw a project. I want to give you a hint on a given question. May 2016. Question 1. May 2016, question 1. Question 1, part B, you are told that Planet Limited is considering undertaking a 20-year project which requires an initial investment of 250 million. That's the initial investment. That's the present value of cash outflow in a real estate partnership, and whose present value of the expected cash flows is 254 million. That's what we call the present value of cash inflow. So is the project profitable? NPV is the present value of cash inflow. You raise the present value of cash outflow. I told that the present value of the expected cash flow is 254, and the present value of cash outflow, we're investing 250 million. So it's 4 million. So the project is viable. Planet Limited has the option to abandon. Now that's what we call the lead option. So in this case, the lead option is not to invest, but to abandon. Yeah, Planet Limited has an option to abandon the project anytime in the next 5 years for 150 million. The variance in the present value of the cash flow is 0.09, and the 5-year risk-free rate is 7%. Required. The net present value of the project, which is 4 million, including the option to abandon the project. The option to abandon. Then number 2, comment on the result obtained in B above, note, bracket, option, pricing model, blah, blah, all that. Now the question is, give me P. P is 254, correct. Give me E. 200 and? It's 150. Now, what's the lead option in this case? To abandon. So the lead option is to abandon, not to invest. Now, the project is for 20 years. But you're told that Planet Limited has an option to abandon the project anytime in the next 5 years for 150. If you abandon that, means you are selling that project at 150. So you exercise that lead option for 150. And that's why you say that the exercise price is the present value of cash outflow. But if it's the lead option is to abandon, you take the abandonment what? Value. So if we abandon, we'll abandon it at 150. Now that's what we call the exercise value. What about T? T is correct. You see, the project was for 20 years, but the lead option is to abandon in the next 5 years. So T is 5. Good. Then from there, you follow all the process. But in this case, the lead option is to abandon. What do you mean by to abandon? It's right. You say you abandon, yeah, but you abandon and then you realize 150. It's like you'll sell it at 150. If you are selling, is it a call or a put option? If you are listening what I was explaining, if you are selling it at 150, you are abandoning it at 150. That's the salvage value. Is it a call or put option? That's put. You are the seller, you are the one selling. Are you together? So if you are selling, you also need to get the value of the put. So what you'll do, you evaluate the way we did here until you get the value of the call. Once you get the value of the call, then you compute the value of the put. And if you look at the question B, where you have the notes. Note number 1 was the bracket and score option pricing model. Then number 2, you also given the put call parity relationship. Good. So the solution is already in your notes. So, but I think I've highlighted all the major points. And that marks the end of that topic for derivatives.